Okay, let's take a look at this pension plan 2-year worksheet. I'll read the problem which appears at the top. On January 1st, 2008, Diana Peter Company has the following defined benefit pension plan balances. Looks like we've got $4,200,000 right there in projected benefits obligations, and we've got fair value of plan assets also equal to $4.2 million. The interest or settlement rate applicable to the plan is 10%. On January 1st, 2009, the company amends its pension agreement so that the costs of $500,000, so that service costs of $500,000 right there are created. And then we've got some other data here as well. Oh, and I better show a little bit more of this so we can see what the data is per year. Okay, we need to prepare a pension worksheet for the pension plan for 2008 and 2009. So let's get started on that. The first thing we need to do is put in the beginning balances. So the projected benefit obligation is $4,200,000 to start, and the plan assets are $4,200,000 as well. Okay, and if you want to think about that, that would be a credit and that would be a debit. I'm wondering if I should do this in debits and credits so that you can see it. Yeah, why don't we do it that way? So anytime I'll put a credit in, we'll enter it as a negative. Okay, so our credits are equal to our debits as we start off on our worksheet. Okay, the first thing we notice is service cost for 2008. It's $150,000. Of course, we would debit annual pension expense for $150,000. So we'll show that as a positive number, debit being positive and a credit being negative. So the projected benefit obligation goes up by that $150,000 as well. Okay, so we're still in balance. Then we look at item C, which is the actual return. I'm sorry, the interest cost is item B. Item B, the interest cost is 10% of the applicable rate. Okay, so to calculate that, we're going to take 10% of the beginning projected benefits obligation of 4.2%. So we'll take 10% times that 10%, and 10% times the $4,200,000. We come up with an interest cost of $420,000. Okay, if we've got an increase in the interest cost of $420,000, then that also means that we're going to have an obligation equal to that interest cost, right? So it stays in balance. All right, now the actual return, they tell us is what? I believe they give us that information, $252,000. So now the actual return then is a decrease in our pension expense, right? It's income. So we'll subtract off the $252,000, and that $252,000 then shows up as a positive increase in our plan assets, right? Because if we actually made that amount of money, we've increased our plan assets by the $252,000. So in terms of our annual pension expense, it's a reduction of what our pension expense is. It's an increase in the assets. All right, then we need to take a look at funding. And contributions or funding of the plan shows up right there with $140,000. So it looks like it's funded with cash. We need to credit cash because we funded our pension. Our pension obligations, or we funded our pension plan, is one other way of saying that, for $140,000, and that then increases the plan assets by the $140,000 as well. Okay, so we decrease cash by $140,000, the plan assets increase by $140,000. Okay. The next thing we need to look at is benefits. Benefits paid are $200,000 for 2008. So with projected plan benefits of $200,000 being paid, that increases our obligation by that amount of 200,000. So we need to show that is, or I'm sorry, let me follow this right. This is the benefits paid, not the benefits accrued, but the benefits actually paid. Well, if we paid the benefits, it lowers our projected obligations. So we've got a debit there of the benefits paid of 200,000. Okay? And if we've actually paid the 200,000, then that it comes from the plan's assets. So we need to back off the 200,000 from the plan assets. We're still in balance. So at 1231 then, if we sum from above, let's see what we get. We've got $318,000 of a debit. We've got $140,000 of a credit. And we haven't yet talked about prepaid and accrued costs. Okay, well, the prepaid and accrued cost represents the amount, it essentially represents the forced amount. If we've calculated our annual pension expense at $318,000, and we've also determined that we actually funded $140,000 out of the business, then what that means is we've either had a prepaid or accrued amount for the difference. So in this case, our debits are greater than our credits. So we know that that difference has to be equal to the 318 minus the 140,000. I got to add those together, and that comes up to 178. But it's a shortfall, if you will. So I want to convert that into a negative number. Okay. So now we see the journal entry that we would need to make on the book of pension of the Diana Peter Company. All right, now let's keep moving on and see what's our total for the plan assets. Okay, well, at this point, really what we want to do is put our formula together, which is really just a sum from above. Now in that one it's only one line item. This one we can sum from above. And we come up with 4570 as a credit, sum from above here. And we've got 4392 is a debit. So now the plan assets at the end of 12/31/08 are equal to $4,392,000. The projected benefit obligation has shifted now to $4,570,000. And we have to record the journal entry to reflect that. All right, now let's take a look at the prior service cost, which is adjustment F. All right, so up here it says, on January 1st, 2009, the company amends its pension agreement so that the service cost of $500,000 are created. And that's what we're talking about with our new service cost here, if I can get to it. And we need to show that increase of the new service costs on our projected benefit. So we've got a $500,000 amount there, and as a memo item, we also record the unrecognized prior service cost of $500,000, and we can show that in that memo column. Again, we're in balance. And then, of course, summing from above. If I can do this right. Oh, I hit the wrong button. Excuse me. Here I'm going to sum from above just these two items. And now we're up to a projected benefit of $5,070,000. All right, G says what's our service cost for the second year, and that's that $180,000. Now this should look very similar to what we did for 2008. We need to enter $180,000 there, and then we need to record the increase in the projected benefits of $180,000. Moving along, the interest cost. Now this gets a little bit complicated. Okay, the interest cost was pretty straightforward in the first year, right? And actually, it was simply the amount of the projected obligation times the 10%. And by the way, the projected benefits obligation and the fair value of the plan assets were the same. Now when we take a look at H, it gets a little bit more complicated. We've got to come up with that 5070 obligation and multiply that times 10%. So now our interest cost is equal to 10% again times the 5070, our new prior service costs. Okay, so we've got a $507,000 amount, and I need to make that a negative amount so that it shows what the pension expense is, right? And then once we have that, that's an increase in our projected benefits, again, of $507,000, and we're in balance. Now, the actual return in the second year is that $260,000. So we grab the $260,000 there, and the actual return is a reduction again in the pension amount, so I need to turn that into a negative amount. So there's our $260,000 credit, which lowers our, which we show is an increase in the plan assets. So that goes under plan assets of $260,000. All right, let me slide and give us a little bit more room here so if we can finish this up.